MIRA Business FM. The sound of success.
It's the morning drive. What the Strait of Hormuz crisis means for your money now. UAE petrol prices are up 8% for June, reaching their highest level in nearly 4 years. Concerns grow, of course, over tensions between the US and Iran and the Strait of Hormuz. Now, with fuel prices already rising, what about pressure ahead on consumers, on businesses and investors? That's the topic. Ryan Lamond is the founder and CEO of Neovision Wealth Management. Ryan, welcome back to the show.
Good morning, Tim. How are you?
Good, thank you. You're welcome with us, of course. And I'm really kind of looking for your thoughts on, I guess, the markets where investors should be paying attention this morning. So it will be kind of a broad, wide-ranging conversation. Bear with me. To begin with, though, UAE petrol prices up 8%, as I say, nearly a 4-year high. Global energy markets are pricing in a steep risk premium, of course. Queues for petrol on Sunday were noticeably longer than usual. Direct economic fallout of intensifying regional friction. It's a time of economic uncertainty, Ryan, and 90 days in, broadly, what does it mean for our personal cash flow, for business overheads and investment portfolios? What would you respond to if I put that to you?
Well, first of all, thanks for having me again. We are getting into the territory of worst-case scenario. When this whole thing started, we all thought this is going to be 2-3 weeks, and then it's going to be solved, because closing the Strait of Hormuz is not something simple. It's a major event. The problem is that what has been helping oil prices to remain relatively tame are the reserves that most countries have, and most countries have oil and gas reserves 3 to 6 months, with it being more closer to 3 months for most countries. So most energy experts are saying that as we get closer to the end of June, many countries around the world would have depleted the reserves they have, and the buffer they've been ensuring for the countries that prices remain tame is no longer there. So every day that passes in the month of June, we're getting closer to that cliff whereby reserves get to very dangerous levels, where oil prices would probably spike because there will be bidding on who's going to get the oil barrel that is very much needed. Now, all of this is interlinked with AI. As we know, AI data centers, the input is energy. This is the basic factor of production. It's the most important basic factor of production for AI, energy. We've been seeing two techs here. We've been seeing the sellers of picks and shovels, like Nvidia, Micron, and others, and these have been generating substantial revenue, rallying, etc. And then we have the AI companies, who are the users of the picks and shovels that are being sold. So these rely on data centers. Without data centers, we cannot have AI. So when data centers are energy hungry, and energy is very expensive at the moment, we're going through the biggest oil shock in human history, then AI becomes expensive. And this is exactly what we're seeing. So when you're paying $200 for your max subscription with AI or Anthropic, you're actually consuming $3,000 to $10,000 of tokens per month. So the difference, this is a subsidy being covered by VCs. And this is what investors have to be aware of. The whole rally we're seeing at the moment in the US is primarily driven by AI-related companies and sellers of pick shovels for AI companies. So the model at the moment is flawed because it's based on subsidies, and the subsidy is being covered by VC, venture capital companies, private equity companies. But for how long? So all of this is interlinked. The advice is hold off for now.
I mean, the VCs are going to want their money back. The question is, when are they going to get their money back? So there's another question not far down the road as well in that regard. An 8% jump at the pumps is a stark reminder, Ryan, isn't it, of just how quickly global geopolitics hits the likes of you and I. Let me just ask you this. Is this spike a temporary kind of knee-jerk reaction, or are we settling into a more sustained high-cost energy cycle?
That's a very good question. If you look at before the war started, the Strait of Hormuz, the US was struggling to bring in the inflation below 3%. We're still in the aftermath of COVID, 2020, 2021, talking 5 years ago, right?
Yeah.
So today, we're going through the biggest energy shock in history. What will happen now, best case scenario, if war stops today and the Strait opens today, is 3 years of inflation. Base case is 5 years, and worst case is 7 to 10 years of higher inflation. Uh, this is how we see things. Inflation is very sticky, especially when it's coming from energy. So and disruption of supply chains. And this is what we're going through at the moment. If you give me the choice between recession and inflation, I'll choose recession any time of the day. Inflation hits absolutely everyone. You, I, the rich, the poor, everyone. It hits everyone. A recession only hits people who lose their jobs. In a recession, if you have your job, you're getting your salary, you're living completely normally. You do not even feel there's a recession. So this is why inflation is always worse for an economy than a recession. And last, several central banks around the world have fought inflation by pushing the economies of these countries into recession to tame inflation. So what will happen is stagflation, because at the moment, growth is sluggish. It's mainly driven by AI, unfortunately. And at the same time, we're getting inflation. So this is what's hitting you and I, basically.
I almost wish we hadn't invited you on this morning. But with the greatest of respect. But no, it's interesting. Let me ask you this then. If tensions remain as they are right now, or hopefully not, but perhaps escalate further, just how high, in your opinion, I understand that this is an opinion, how high could oil prices realistically go?
So if we hit the end of June, and the reserves in many countries that I mentioned are depleted or close to being depleted,
Yeah.
I wouldn't be surprised to see oil prices at $200. And but even higher, I wouldn't be surprised even higher. There are some countries in Asia that are rationing gasoline for cars. So rationing has started. A number of major international airlines, specifically in Europe, are starting to cut down long-haul flights because they're starting to feel the pain on jet fuel side. So we're already starting to feel it. If it continues until the end of June, yes, there will be a bidding war for oil prices, for oil barrels.
Okay, let's look at the operational mechanics for businesses and dial this back a little bit. When fuel costs jump 8% in a month, it triggers a domino effect, doesn't it, across corporate balance sheets. So for UAE companies that may already be grappling, if you like, with expanding teams, complexities of scaling up, the pressures of day-to-day business operations, how quickly do these transport hikes morph into broader inflationary pressure? Who absorbs the cost and who gets squeezed first?
Well, basically, it's you and I. Sellers, wholesalers, they always pass it to the consumer. And what we're seeing, thanks to tech, the price diffusion mechanism is today much, much quicker than it used to be years ago. So when we had inflation in the 1980s or 90s, from the shock to it translating into the end product, we used to observe 6 to 12 months of lag. Today, no, it's happening instantaneously because today we have the electronic tools to pass on and calculate and impact the end product that the consumer, that you and I are buying. So the price diffusion process from the shock to the product now is almost instantaneous. And we're starting to feel it. I was in Europe, in the UK, in Paris, and Geneva just 2 weeks ago, and I was very much surprised of certain products that I like to buy when I go back home. Prices are much, much higher than I observed on my last trip back in January, just a few months ago. So we are seeing it already.
I mean, high fuel prices kind of quietly sort of seep into food, into construction materials and manufacturing indices over, it's fast, it's 30, 60 days, isn't it?
Absolutely. It's very quick. And even you can see companies hedging in advance because they have access to the same pricing feed that anyone would get. And they know how to prepare in advance and hike up prices so they don't have to cover the gap between the price hike and selling it to the consumer, so that the consumer would actually buy it at the price commensurate with the input price.
Let me ask you about stock markets. How vulnerable are you seeing stock markets to, or how vulnerable do you see stock markets being to a prolonged disruption in the Strait of Hormuz?
So the problem, again, it's interlinked. The rally that we're seeing mainly in the US is AI driven. This is undeniable. If you remove the AI component from the S&P 500, it's flat over the year, actually. Zero, no performance. You add the AI component, it's 12% up. So it's mainly driven by AI. And this whole AI idea is based on adoption, that you and I will be using AI every single day and pay for it. Now, how much do we pay for it? At the moment, most users are paying $20 or $22 a month, right? This is covering a very small portion of AI usage because the actual cost today, because of the energy hike that is feeding into the data centers who are very energy hungry, today is making a big gap. So this whole thesis of the rise in US stock markets is based on that. How long will it be sustainable? I don't know. If the Strait of Hormuz continue to be shut down for months from today, oil prices go up, as we just mentioned, then this whole AI thesis will break down. And I doubt that the rally that we're seeing at the moment in the US could continue. And then this will impact the whole world as usual, because the US catches a cold, the rest of the world gets a pneumonia.
The old adages always come true, don't they? So on paper, AI looks like a sure bet at the moment, but it sounds to me as though you're describing a potential, well, certainly a potential bubble.
For me, it is a bubble, 100%. And let's remind the investors, bubbles could last years. A bubble doesn't mean it will blow up in 3 months or 6 months. Look at the internet bubble. It lasted several years. But the problem is the aftermath of that bubble. So basically, after the internet bubble, it took investors 10 to 12 years to go back to the original prices they bought stocks at. So a bubble, once it bursts, is not really transitory or a very short term. It lasts a generation until you recover your money back. Now, what helps the recovery is usually the central banks, the Federal Reserve.
Yep.
If you look at the Federal Reserve, let's say today the stock market blows up and that this bubble bursts. They will have to intervene through quantitative easing, etc. But the balance sheet of the Federal Reserve is already massive. It's the highest in history. So how much more will they expand their balance sheet to avoid the stock market crash and preserve the stability? I have many more questions than answers, I'm afraid, because this is completely uncharted territory for us.
Well, it is, isn't it? Just a reminder, this is The Morning Drive. You can catch up with previous conversations directly through our website at MIRABusiness.fm. This interview will be uploaded to YouTube later today. Ryan, let's consider wealth management and capital protection, the personal financial perspective, if you like. For a local investor sitting on cash or maybe managing a standard equity portfolio right now, what is the defensive playbook? Because if the Strait of Hormuz remains a high friction zone through the summer, let's make that assumption for a moment, how do we reallocate assets to insulate capital?
The first point is not to panic. I know a lot of what I'm saying is alarmist, but this is no cause for panic. We've seen pandemics, we've seen world wars, we've seen recessions, we've seen a financial crisis in 2007, 2008 that put countries to their knees. Where are we today? We recovered. We as humans can fight these through economic and financial policy. So no reason to panic. and start panicking with investments. Second is to invest into companies that actually generate revenue and generate dividends. Let me give you an example. Anthropic, the company behind Claude, the current market valuation is $965 billion. The company generates $50 billion of top line revenue, not profit, top line revenue. Compared to Samsung, Samsung has a market valuation of $850 billion and it generates $260 billion of revenue. Which one would you like to invest in? In the shiny AI company or in the company that has sure, sustained, dividend paying revenue? So this is what investors should look at. For example, I give you myself, and this is not investment advice, 60% of my own personal family wealth is in Swiss stocks. Nestle, Novartis, people will always eat chocolate. People will always consume medicine from Novartis. So look for sure bets that investors will always buy their products and that pay you dividends. This is how you protect yourself from inflation and from all of the mess that we're going through at the moment.
I have to say, that's probably the most memorable piece of financial advice I've received, and I've received a lot, but people will always eat chocolate will stick with me, Ryan, and I'm glad to announce that as well. Can we look at the macro fundamentals, how institutional investors are positioning themselves amid the uncertainty? From an institutional wealth manager's view, what are the specific triggers or, I don't know, milestones that you're monitoring right now?
So institutional investors are mainly private investment type of investors rather than liquid markets. So they don't go chasing NVIDIA and AI. They really look at private investments. And on that front, yes, some of them are holding off for the moment until it's clearer. Because one very important factor in private investing are interest rates. This is how you calculate your future cash flow once you get your money back in 5 to 7 years. Private investments have a lifespan of 5 to 7 years. So you have to know what interest rates will be. If interest rates will be 3% over the 5 to 7 years, valuation will be something. And if you expect interest rates to be 8 to 10%, then valuation is completely different. And since we are in a very volatile situation, many of these institutional investors are, for the moment, holding off until the dust settles and they see what valuation they will invest in. Many of them are looking again at sure bets that are decorrelated with what is happening, whether on the energy side or the tech side, but mostly it's pausing.
I wanted to bring back the point you made earlier on that, you know, there is panic is the opposite of what you should do. And I think it's a good point to make because there is an ironic kind of structural upside there, isn't there? In terms of regional financial strength, sustained higher oil prices increase fiscal surpluses of GCC governments. That bolsters potentially huge sovereign wealth power, which can be reinvested domestically in infrastructure, in tech, in whatever. And I think it's also worth remembering that the UAE's economy's built exceptional structural buffers over the decades to decouple domestic economic growth from immediate, kind of maritime issues that we're seeing as well.
Absolutely, Tim. And just to reiterate what I spoke about on our last encounter, is that I refuse to talk about the resilience of the UAE. I really refuse to, because talking about it makes it a thing. Do we ever question Hong Kong's resilience? Do we ever question Singapore's resilience? Yes, the UAE today is at that level, and I'm not going to discuss resilience anymore. The second thing I would like to mention to the listeners today is in the UAE today, yes, we are facing some very serious risks. And let me expose them to you in the order that I see them, Tim. Yeah. The first risk is the sun. Today, the weather is very hot. When I go outside, the sun is so strong, it's really burning my skin. So I had my dermatologist tell me that I have to use cream. This is a very important risk that I'm facing in the UAE today. The second risk is yesterday I went for a 10-minute walk. I was completely dehydrated. I didn't drink enough water. I almost fainted. So these are the type of risks we're facing in the UAE today, Tim, and nothing more than that.
It puts it in perspective. I'm with you on the resilience thing. It's a word we use far too often, I have to say, but it's the word of the moment, isn't it? Beyond oil and gas, Ryan, what other asset classes, and I know this is me jumping around, but I'm just interested in your opinion, what other asset classes could benefit from the current geopolitical environment?
From the current well, it's oil, everything energy related,
Sure.
unless and until we reach a breaking point, then it doesn't matter anymore. But the thing is with energy is that you need to be able to sell that product in a safe, non-risky way without the insurance over it eating into your margins. So this is very important. Um, uh, what can I can think of banking potentially, because as interest rates go up because of inflation on the back of higher energy, banks could benefit from higher interest rates, especially when interest rates are moving. This is when banks can make money. Um, Financial institutions could also make money because we see volatility on financial markets, and usually financial institutions like brokers, etc., they make money on trading. So the more you trade in and out, as people panic, unfortunately, this is how financial institutions make money on the transaction costs. As you go in and out, try to short, call options, put options to hedge yourself. Uh, it's it's a it's a win for financial institutions.
I know that we all share the sentiment and we're all hopeful of a diplomatic breakthrough and that happening soon. But in your opinion, how quickly could oil prices retreat were we to, hear of a diplomatic breakthrough?
I will just speak of what energy experts are saying.
Yeah.
The first point is that you have multiple refineries, gas and oil, that are shut down. It takes roughly 3 to 4 months to reactivate these refineries to go back to full production. That's the first hurdle. The second hurdle is purely maritime. If you speak with maritime experts, they tell you if the Strait of Hormuz opens today, it takes roughly 2 months for the maritime flow traffic to go back to normal, to pre-crisis. So here we're talking 4 to 6 months to go back to completely normal oil flow through the Strait of Hormuz. And here we're talking about 21% of world oil and gas exports. The 1970s shock affected only 7% of the world's export of oil and gas. Today it's 21%. Over 6 months, well, I do suspect that oil prices will remain $80 to $100 for quite some time, even if there's a peace deal today.
Okay, so numbers at the pump are likely to remain high. The headlines look volatile. Successful investing is very much about not panicking, as you pointed out,
Yep.
but also divorcing the emotion from the data and the data from the emotion, I suppose, as well. If you know how to map the risk, you can protect the yield. Easier said than done.
Absolutely. And this is where you have to look for the companies that actually not only grow in price, so you buy a stock at 10 and you sell it at 15, you have to find the stocks that actually pay you a cash flow, a revenue, and this is called dividends. And this is why, to go back to my chocolates example, Nestle pays you dividends. It's a fantastic company that generates these dividends and pays you. Same thing with Novartis, the Swiss medicines company. So I'm not only betting on the stock going from 10 to 15. I'm not looking for that. I'm looking for the company that is stable, non-cyclical. That's very important. So uncorrelated to this whole mess, and it pays me cash flow. And then my anchor is again and again gold. And gold is not purchased in one go. Gold is like a saving. You buy it every single month. So you're not sensitive to price movements when gold prices go to 5,000 or 5,500 and then go back to 4,500. You need to be completely agnostic of this by buying every month. And let me just remind listeners, just 1 year ago, gold prices were at $3,300. Today, we are at $4,500. It's the best performing asset out there.
It is. Ryan, it's always a pleasure to hear from you. And that memorable phrase, people will always eat chocolate, is still ringing around my headphones at the moment. Ryan Lamond is the founder and CEO of Neovision Wealth Management. Thanks for joining us, Ryan.
Thanks for having me, Tim.
Appreciate it. This is The Morning Drive. It's MIRA Business FM.
MIRA Business FM, where business comes to talk. MIRA Business FM. The sound of success.
It's the morning drive, real estate now. Where to invest in Dubai? That's the question. Well, actually, the question is when and where to invest in Dubai, more specifically. But AJ Menon has all the answers, and I'm fully confident that he can answer this question. He's from Lux Vista Real Estate. He's the CEO. Back in the studio. Nice to see you.
Likewise, Tim. Morning.
So, where to invest in Dubai? When and where to invest? Your thesis, off you go.
Like this, when to invest. The best day was always yesterday.
Always yesterday, yeah. Day before yesterday, you should have done it. But there's no time like the present, is there?
See, what people do is they take Dubai or UAE as one market. That's the biggest mistake you can ever do.
Okay.
Because Dubai is a city within a city, and they've got multiple micro cities within Dubai.
Yeah. Do you know, people always talk about London, and there are two camps in London. I'm from just outside London originally, right? So I look at it as lots of villages in like a greater kind of area. And there's always pushback to that. It's people, it's not like that at all. It's not. And I always think, no, it is kind of like that to me, but that's only my perspective. But Dubai is a bit like that. We kind of live in our little enclaves, our areas, and they're very distinct.
So you can actually divide this by locations. You can divide this by master communities.
Yeah.
Again, going back to London, if you take London or UK as a whole, 60% of UK is London. If you take London away, what is there?
I can't even comment on that. It's far too contentious. But I know what you mean. But I mean, if that's the example, you've got what, 12? Is it 11 or 12 million people? I think in London now, something like that.
Something like that.
And that's 15, 20% of the population at the moment. It's something. It's around about 15%, I think. So I get your point. But what you're saying basically, Dubai is basically lots of like micro cities.
That is correct. Yes.
Yeah.
So,
That makes sense.
And that's the whole point, because see, what Dubai tried to do was they're following the 2040 master plan.
Right.
And according to 2040 master plan, they wanted to divide Dubai into 5 areas or 5 segments. So we're looking at areas like Deir Aba Dubai, which is the historic place.
Yeah.
That's where they are in touch with their cultural identity.
Yeah.
And progressing towards modernity. So they want to preserve that, the heritage, the culture. So that is why it's called the heritage place. Then you have your DIFC, Downtown and Business Bay, which is your financial center, where all the businesses are.
Yeah.
Then you've got your JBR, anything from Dubai Islands all the way to Palm Jumeirah, Palm Jebel Ali. So that is going to be your tourism, hospitality, leisure, that segment.
Okay.
The next one is, of course, Expo City, Dubai South, which is the new economic and logistical hub. And then you have Dubai Silicon Oasis, which is going to be the innovation and tech hub of the world. So this is the concept, this is the core concept and the core agenda behind the 2040 master plan. Okay,
so this is the master plan. We've talked a lot about Expo City, Dubai South, as that's kind of the next place, isn't it? Yeah.
We'll keep talking about it.
I know. New economics and logistics centre, and of course DXB Dubai Airport moving to Al Maktoum as well.
Yeah. So that was when they decided, yes, the Expo City, Dubai South is going to be the next economical hub or the logistical hub. In 2024, they decided that they will move Dubai DXB or Dubai International Airport to DWC or Al Maktoum International Airport.
Right.
And there's also a fact because the DXB was getting completely packed. There is no scope for expansion in that area. So they had to really plan a huge area, which is, they say, almost the size of Hong Kong as the new airport area. And that is the whole thing. The whole point of transition started from that point.
Gotcha.
Okay. And because of that, they thought that they will do it within a decade. 2024 all the way to 2034. But now what has been decided is basically the transition will happen in 2032, and that will happen immediately. It's not in phases. It's going to be closed the thing, and then obviously they're going to open everything in 2032. But it is going to be a big airport. Total capacity to be ranged will be 260 million passengers. That whole thing will go all the way up to 2057.
Right, okay. And we're currently, capacity is something like 100 million passengers?
90 million, which
Okay.
we can go up to 110-ish. So, and that is when they're bursting from the seams, so they have to move there.
Right, okay. And we're looking at 260 million.
Yes, eventually.
Anyway.
Yeah.
Okay. Completed by 2057. So the biggest airport transition
In the world.
the world. Okay. If you're watching on YouTube, don't forget, subscribe to our MIRA Business FM channel. So what happens to North Dubai then, AJ? Dubai Islands, DXB area?
Yes, that Dubai Islands, of course, we'll talk about Dubai Islands first, because Dubai Islands, the master plan obviously is by Nakheel. They've sold it to multiple developers. Developments are happening. They have launched. In fact, the first property is already handed over. So you still have a lot more handing over now.
Right.
So what you should understand is this is directly under the flight path as of now, under the DXB. And you have airport noise. You have noise because the aircrafts are taking off and on top of you. So basically, because of that, there is a restriction on building heights and density.
Right.
But what you need to know is this is moving from 2032 onwards. So any real returns, you can expect it post 2032. Till then, the residents will have to adjust with the noise. It is not that bad. People are living under mid-diff these days, but it is not a pleasurable experience when people are coming from all over the world. They are living in a beachfront area. The idea is holiday and relaxation and tourism.
Yeah.
So if you have these aircrafts going every other hour, it's not really the best experience, I would say.
But it's a good point, though, because it's something I hadn't thought about. So until 2032, there are going to be noise issues.
Yes.
Right. But after that, you can, you can't bank the returns, but you can look at returns.
And that is the reason why people should be looking at it now, because once an area becomes problem-free, then the interest goes up. When you are actually buying a place with current problems, even the developers, they can't charge you much. Even now it's going up, because initially it was 1,800 dirham per square foot. The recent launches are almost about between 3 and 3,400 dirham per square foot.
Okay. So the natural next question is DXB, the airport, the area, 100 million people coming through there. It's a swathe of land, isn't it?
Yes.
I guess that could be prime real estate.
That is the elephant in the room. We always been. Some consultants like me, we're trying to be, keep up with the government. And it's basically piggybacking on the government. Wherever the government goes, I go. So we were talking. It was kind of speculation at the time. But the interview with Mr. Paul Griffith, the CEO of the Dubai airport, confirms it. So he said, this land has been in the crosshairs of many prominent developers.
Yeah.
And it will be, because once the airport transition happens, definitely it is prime real estate.
Yeah,
and
well, you would think so.
Yeah. And obviously you can have a lot of mixed use, commercial, residential, a lot of things can happen in that area. And if something is happening, definitely the first mover advantage is, just get in.
Yeah, I think something that people don't realise as well, that Dubai DXB is in the middle of Dubai. It's in the centre of the city, and always has been. And we're so used to it, you don't really consider it.
I know. And since now, if they are going to remove that whole area, that can be a city completely planned from scratch.
Yeah.
So you can, it's very difficult to add existing city into, to create space, to create roads. It's going to be very difficult. But if you're going to plan something from the beginning, it's like, it's very easy to plan.
Yeah. All right, then. So that's Dubai North. Let's talk about Dubai South, because it's an area, a location, a place that we've talked about a lot before, and I know it's something that you like to discuss.
Yes, definitely, because again, if Dubai has the idea of generating 65% of the GDP from Dubai South alone.
Yeah.
So we will be talking about it for a long time. We're just starting with Dubai South. So what is going to again happen with Dubai South? We have two things that was really announced very, very recently.
Okay.
So two days.
This is middle of May, was it? It was a couple of weeks ago.
Few days back.
Yeah.
We are looking at May 18th, 2026.
That's right. Yeah.
Okay, and Emirates signed a 5.1 billion US dollar worth of project,
Okay.
a complex engineering project in Dubai South. We are talking about the world's biggest and modern MRO, which is mechanical repair overall company for aircrafts.
Right.
So that the whole area we're talking about is around 1.1 million square meters. And the biggest free span hangar, which is 285 meters wide. So imagine the number of aircrafts you can park there and then do the repairs.
Wow. Okay, so that's going to mean lots of jobs. That's going to mean lots of people living in the area. So lots of real
Demand,
estate.
real estate supply, everything has to come in place.
Okay, that makes sense. I'm following the logic. There was another announcement as well. One on May the 18th, one on May the 19th.
This is basically within 24 hours.
Yeah.
So that is by Majid Al Futtaim, one of the most reputed developer retail giant in the Middle East. They operate city center, they operate Mall of the Emirates.
Yeah.
So they came up with a master community of 62 billion dirhams worth of master community in Dubai South. They signed the agreement with them. They will have, again, mixed use. We're talking about residential, we're talking about commercial, retail, and anchored by a big mall. I mean, obviously, when they come with a mall.
Well, obviously they do. Just for anybody listening that doesn't work in dirhams, 62 billion dirhams is what? 17 billion dollars. That's a huge community. Okay, so you've got the largest aviation institute, you've got maybe one of the most credible retail community developers committing billions to the same postcode. I'm following your logic here. I'm starting to see how this all fits. It's almost like somebody planned it.
Exactly. There is nothing. Coincidence is a very rare term.
True. There's a phrase that you used. You sent me some notes about this. So let me just read what you've written. Both commits billions to the same postcode within 24 hours. It's not speculation. That is, and I like this phrase, conviction
capital.
Yeah, that's great. Okay, so Dubai South is moving forward. So this is a transition.
So now what is Dubai South? So Dubai South is not a future story anymore.
Right.
It's transitioning into a current reality.
Okay.
So definitely you should start talking to people, start talking to consultants, see what is happening, try to get into that market.
Right. So Dubai's property market, right? This is specifically Dubai we're talking about, not the UAE. So we're kind of excluding Abu Dhabi only because this is the topic today. But Dubai's market makes global headlines. That much we all know. Don't need to say it, really. But for someone hearing about it for the first time, why should they even be paying attention?
If the market, it's not about if.
Almost annoying.
It's not about the if. It's about when the market recovers.
Yes.
You should look at history. Forget Dubai. Just look at the GCC countries. These are kingdoms. They are not democracies. They do not need time. They don't have bureaucratic long channels.
Yes.
So the decision is taken immediately, and the recoveries are always quicker than any democracies out there.
Yeah, historically that has been borne out. Okay, so
and in this democracy, I mean these kingdoms, Dubai always stands out because Dubai has always been proactive. They were number one. They will always be number one.
It's funny. I was talking to somebody yesterday in the studio, and he'd been here. He only came. I think it was the end of last year, November last year. And I said, why did you move the company to like a software advertising software company? He said, well, because I just came on holiday and I really like the attitude. It has the kind of a can-do attitude that I don't come from. I haven't experienced. So. Okay, it's anecdotal, but there's also there's that feeling as well. People always say location. In Dubai, is it more about timing? What does the current window look like for investors?
See, it's all about timing. See, and the thing is, eventually every place will grow. Yes. People, before few days back, gold metro line was the thing. But what people should understand is, every place in Dubai will be connected by metro at some stage or other. So it's not about, when you buy near the metro, it's going to appreciate. Yes, when you're buying now, for the next, if there is a metro, yes, there is a price appreciation in the next few years. But give it a 10 years window. By 2032, all of Dubai is going to be connected by metro. So what is special between this place and that place? Because they are all connected by the metro.
Fair enough. I've got a load of questions ready that I wanted to ask you, and we've got a little bit of time today. So just a few things that I wanted to put to you. Based on, the topic today, AJ, is there ever a bad time to invest in Dubai? Or has the market reached a level of maturity where the entry point doesn't really matter anymore?
Look at any other global city. Take London, for example. London has been there for centuries, right?
Sure.
But people are still buying now.
Yep.
People are still making money.
Yep.
It's the same with Dubai. Because again, it depends on what your goal is. If you want to enter now, make money in the next 3 years, 5 years, if you don't want that to happen, okay, you're buying a place to live and you want it to appreciate in the next 15, 20 years, any time is good time.
Okay.
But if you're looking at something, when people have a investment horizon, timeline.
Yeah.
So if I want to invest money in, say, Palm Jubilee now and expect returns within the next 5 years, it is not a good place. It's more of a 10-year game.
Right.
Right. So that is what I mean by timing. If I want to invest something in Expo City, yes, this is the time. But Dubai South, it will take a little bit more time.
Sure.
So Expo City is within the greater Dubai South region, but it is a completely different ballgame.
Okay. So let me ask you a little bit more about timing perspective then. The off-plan versus ready properties. From a timing perspective, which one makes more sense in today's market and why do you think?
So if you're planning a villa, for you to stay and eventually grow in value, what you should be looking at is if you have shorter time horizon with you, you should be looking at something an off-plan secondary,
right,
which is going to be ready the end of next year, 28 mid. Because all the new off-plan projects are going to be ready in either 2029 or 2030 or onwards.
Right.
So if you have enough time to wait, you don't mind, you're not calculating what is my yearly return, then obviously you can go for that because that gives you, flexibility in payments and let it take its own time. I will live when I want to live, it's ready, or I will sell it at that point of time. Timing, unfortunately, sometimes it might work very adversely without intention. So what now happened? Because of the conflict, whatever units that were handed over now, especially with some people, if they wanted to, their idea was the short-term rental market. It was horrible timing to get your unit. So, but that's pure luck or unluck. Nobody is expecting this situation.
No, absolutely not. I mean, it's we've said it a million times, haven't we? Extraordinary events. Another question I wanted to ask you. We've seen cycles in Dubai before, 2008, 2014. Any warning signs that investors should be watching for at the moment?
I think rating agencies have always been talking about oversupply. News have been coming up with oversupply. But then what people don't analyze is it's not about, okay, you are supposed to have 100,000, 150,000 units coming up by the end of the year. You're supposed to have another 100,000 coming by the end of next year. But these are all launch dates and anticipated completion date. People are not looking at the actual deliveries that have happened over the last 5 years or even before that. Dubai has never, ever supplied more than 45,000 units a year. And suddenly they're not going to double their capacity and make it 80 and 100,000 in this year and next year. It is not happening. So your projection is one thing, your actual reality is another thing. As long as the units are not handed over, we are not going to see any price compressions.
There's a question that we always get in. I've never asked you this, but it's one of the, you're going to be like, oh, here we go. Oh, why is he doing this? But we get this question so much. And the differences are always in the amounts. But if someone has, and let's just say $1 million dirhams, because that's generally the figure. It's either 1 million or 10 million.
Correct.
Somebody's got 1 million dirhams to invest, which is what, 200,000 pounds sterling? That's just under $300,000. So there's the ballpark. Where in Dubai gives them the best return on investment today? You didn't sigh when I asked you, so I take that as a good sign.
It's a very common question because
It is.
The favorite investment amount is anything between 1 and 2 million.
Yes.
So that's the biggest number that we always see. I mean, people always ask this question. So for just a rental, only rental, you're not talking about appreciation. You are still talking about a place like JVC. You're talking about a place like Business Bay, a studio or a 1-bedroom in these areas. Most likely you're looking at a studio in Business Bay or other thing. It is saturated in terms of capital appreciation. But there is a lot of demand for rentals still happening in these two places. If you have time to wait, then definitely I would say you're looking at Jebel Ali downtown. There's an amazing project which is coming in, which is already launched, in fact. Amazing place, because Jebel Ali downtown is also going to be in that Dubai South area, but it has it's on Sheikh Zayed Road. It is just next to your Palm Jebel Ali port. So industrial area. There is nothing livable in and around that area.
Yeah. It's always interesting to get your perspective, AJ. I always appreciate it. AJ Menon is the CEO of Lux Vista Real Estate, based here in Dubai, a proponent of the Dubai way of thinking as well. Good to see you.
Likewise.
Thank you. More business interviews and conversations coming very soon here on MIRA Business FM. And remember, we stream 24/7 on YouTube, on TuneIn and Streamer as well.
MIRA Business FM, where business comes to talk. MIRA Business FM, where business comes to talk.
It's the morning drive. We are talking to a Dubai brand now who are making a public appeal. So running a homegrown manufacturing business in a very competitive global landscape is pretty intense. And at the moment, we have a Dubai brand, a pioneering Dubai brand, I think it's probably fair to say. They're making a raw public appeal for support. Business pressures are challenging lots of local brands. This is the Camel Soap Factory. They've launched its campaign called Save Our Soap, and they aim to sell 25,000 bars of soap to help secure their future. Joining us live, hopefully to talk about exactly what's going on. There's some harsh realities here, I think, as well, is the founder and CEO herself, Stevie Lomas. It's good to meet you.
It's lovely to meet you. Thank you for having me.
You're very welcome. The first observation I would make, Stevie, is putting out a public kind of SOS like this takes courage. It takes some guts to do it. But what led to the SOS, the Save Our Soap campaign?
Well, I guess it's a desperate grasp and an attempt at survival.
Yeah.
This regional war affected us, has impacted us really badly.
Right.
Our business had always been driven by tourism and visitors to the region. I mean, that's why I started the company, was to create a brand that reflected the Middle East, that people could feel like they were taking a little bit of the Middle East home with them. So our business to date really has largely been driven by visitors to, and it's all over the region, not just the UAE. We have a presence in Oman, we have presence in Saudi, in Kuwait, in Bahrain, Qatar. So we're impacted really across the board by people just not visiting the region anymore. And this was the brainchild, actually, of a company that we've been working with called Plug. And Lucy said, time to be vulnerable. And so that's really what's driven this.
How did you feel when Lucy said to you, time to be vulnerable? Because, I guess for most founders, people running their own business, there's an element of, well, there's pride involved. There are so many different emotions involved.
Yeah, it's quite scary.
Yeah, I bet.
It's almost, I guess it's not admitting failure, because it's not failure. This is not a failure of the brand.
These are
it's a
extraordinary
liquidity
times.
It's just a liquidity crisis. Yeah. And actually, I'm really glad she persuaded us and said this. We've had, the response has been amazing so far.
You got some amazing attention. I mean, have you hit 1,000 bars sold yet? This has only been going for what?
Yes.
4,
Can
5?
I put it into perspective though?
Yeah, go on.
In the last 14 years, we've sold 3.5 million bars of soap. That's
a lot of soap. Okay.
So 25,000 is actually not a big amount, but it's enough to keep us going through the summer.
Right.
Believe it or not,
So
yes.
you can pay the bills.
We can pay the bills, I can pay my staff, we can keep ourselves open. And when this charade ends, hopefully we will all be back on the road to recovery.
Let's hope so. I mean, this is a campaign that's about much more than soap. I don't mean to belittle anything, but there's a much more at stake here. And you mentioned it there. I mean, this is about survival. This is about the ability to pay staff. I mean, those are important things you have to do.
And it's for us, it's also about, it's buy local, buy and support the businesses, support the infrastructure and support the businesses that have established themselves here. I mean, I think a lot of people don't realize SMEs, they constitute like across the world 99% of all businesses. From a revenue perspective, a little less, maybe 50, 60% of the GDPs of most countries. But we employ 65% of people. I mean, I have staff from all over the world, but my staff are supporting families all over the world as well. So, supporting business it's a lot more than just supporting Stevie Lomas and the Camel Soap Factory. It's also, it's supporting an ecosystem that really is critical to countries. And I think the UAE has grown a lot. You know, when I first arrived here 24 years ago, there was not really a lot available that was local. And I think that's changed.
It's changed hugely.
Yeah, and for the better.
Yeah. I mean, it was never the case that you would come here on holiday and go back with camel soap not that many years ago.
Yes.
An unusual gift to sort of pass on to people. Your point is well made, though, because it's very easy to look at business and it's just business. You know, it's a business. But it's about people, isn't it?
It's about people. It's about confidence as well. And I get it. It is hard. And it's hard for everybody. I know a lot of companies have cut salaries. I know that means families are struggling to get by on a lot less, which means they're looking at everything they purchase and thinking, well, should I buy that bar of Lux for 2 dirhams or do I buy a local bar that's 20 dirhams? I get it. It can be hard. But you know, what we're saying is that it's more than just buying our soap. It's also about getting people to think about instilling confidence in the business systems here.
I mean, you made a decision, didn't you, that you could have taken, I suppose, an easier route and outsourced production, but you didn't do that. I see you laughing, but your manufacturing footprint is here.
It is.
Right, it's in the UAE.
It is.
Which doesn't make life any easier,
No.
I suppose, in some respects. But tell me about the hidden pressures from, I don't know, local raw material costs or regulatory compliance, whatever it is that makes it maybe more challenging in some ways.
Yes. I probably wouldn't have chosen to have started a factory. My original mentor had
If you
said...
make up my mind, I don't get a factory, that's the way.
That's the way
go,
forward.
yeah.
My husband would laugh at that.
Yeah.
When I first started, I was advised, and they said, see if you can outsource it.
Yeah.
And the truth was I couldn't find anybody
Right.
to make what we make. And one of the things that surprises people is we don't just make for ourselves. We make for dozens of small businesses in the UAE as well.
Okay.
So we make product as well because a lot of people couldn't find a factory like us who could do short batches, smaller runs, who weren't asking them to commit to 70, 80,000 units of product. We can do the smaller things, but it is really challenging. Supply chain at the moment is a nightmare. We've got raw materials and packaging sitting on ships in the Strait of Hormuz. We've had some stuff delivered. We have some stuff sitting, waiting to be delivered. We've got suppliers asking for payment on products that we don't know when we'll see. Right. So there are a lot of challenges. And I think one of the biggest challenges that we all face, especially in manufacturing, is rising costs. So, a shipment that might have cost us 1,500 dirhams to clear is now costing us 6,000 dirhams to clear. That's a huge increase.
That really is.
Yeah. And when you think about, somebody said to me, greedy ship owners. I said, well, not really. These guys have got their ships sitting there, not earning revenues for them. So in the end, somebody has to pay. And I think what will happen, of course, is that it all trickles down to the consumer in the end.
It usually does in the end. Give me an idea, if you would then, of the cost differentials you face manufacturing here compared to competing international brands that outsource. What is that differential?
I think it does mean we understand our costs, but we can't buy in bulk the same way as a Unilever would be able to buy, right. Or one of the really large manufacturers. So they can afford to buy a shipload of bulk soap noodles, for example, from Malaysia.
Is that what they're called? Soap noodles?
Soap noodles, yeah. That's what they... Yeah, we actually make ours from scratch, but we also have a product that uses what's called a soap noodle. Okay. And there's companies in Malaysia and Indonesia that churn out boatloads of very, very cheap soap noodle base. And that's why you can buy a very cheap product on the market. It's got a lot stripped out of it. But for us to be able to really, we can't compete directly with that.
No.
So what we decided to do was to create a different product. It's very high quality. Our soaps, even the soaps that we make that are milled, we use a very high quality base that has got a lot of glycerin in it. Glycerin is sticky. It's really good for the skin, which is why it's ripped out of most products that you buy commercially. But if we process it slower, which means our output is lower on a daily basis, we can produce a really beautiful product that's very skin friendly. I would say we can't compete directly with the large corporations, but what we can do is create something that has a look and feel on the skin that is different.
Okay, and that's the differentiator, isn't it?
Yes, it is.
Okay,
and the camel milk.
And the camel milk as well. So, and I guess that's there's kind of an expectation there, isn't there? So you're in that niche, but there's an expectation that you will pay more for something.
Yes.
Of this order. Okay, but it's difficult because. Not being funny, but soap's everywhere. There's plenty of competition for you.
Yes, there is. And increasingly, there's competition from liquid soaps. A question we're always asked is, when will you come out with liquid soaps?
That's exactly what was in my head.
Yeah. And that's really interesting. I mean, for me, I have a bit of a moral dilemma with liquids because of the plastics. I mean, we throw away oceans of plastic.
True.
And if you look at your bathroom with pump bottles of shampoo, pump bottles of conditioner, yep, you're probably still using shampoo.
Thanks for noticing.
Sorry.
Just about.
But
no, it's a good point. And I'm picturing my bathroom and I'm thinking plastic there's there.
And what do you do with that plastic? You don't recycle it. You chuck it all away.
I recycle it, but I don't know where it goes when it leaves the recycle bin.
Yeah, exactly.
I'm hopeful
as well.
No, I'm with you. I understand that. But I mean, I suppose there's a unique position for maybe a custom-made container that you could produce and do refills. I don't know.
Potentially. I mean, we've brought out a product very recently that is bulk buy, really, and we're selling that to hotels, spas, and salons.
Right.
We're not using camel milk in it. We're using date extract. So that's our kind of regional story. But we feel that I don't feel we can compete with your average liquid soap on the shelf with the kind of product that we can make. And I think one of the things in this part of the world that does help us is that there's a long tradition of bar soaps in this part of the world. Syria, Lebanon, Palestine all produce beautiful soaps, traditionally made with olive oil and laurel leaf oil, rare. And that soap is expensive because of how it's made. It's made by hand. Most of those soaps stand and cure for about a year, which means they can't sell it. So there's storage costs associated with it. But because of that, I think in this part of the world, there is a lot more acceptance of a bar soap that is special. Okay,
which I guess stands you in good stead, in theory. What is it about camel milk?
Yeah.
What does that provide in the soap?
Yeah, that's a good question. So I've always used natural soaps. So there's a difference between the detergent bar that you buy on a shelf for 2 or 3 dirhams and a really beautifully made bar of soap that's been handmade. There's a complete difference. The oils have generally, the glycerin has been stripped out of the commercial ones. They've added hardeners, colorants, all sorts of things so that the bar can be commercially shipped and sold easily and lasts a long time. A natural soap is a little different. So I've always liked soaps and always bought them, soaps made with goat milk, with donkey milk. And initially, I'd really looked and thought about doing a soap made with laurel leaf oil, rar, the Arabic rar. But I couldn't get the ingredient here. It's quite strictly controlled in countries like Lebanon and Syria. Okay. So I had the bright idea at the time of seeing if camel milk would do. And to be honest, in the early days, I had no idea. I had so little idea. I had to Google how to make soaps. And
okay. You've perfected it since, I hasten to add, just to get that, make that straight.
Yeah. So, but I discovered it's a wonderful ingredient.
But it turns out it
is.
Right.
So when I think about the environment camels live in and what the amount of water they've got and how rich the milk needs to be to raise a calf in a desert environment.
That makes
they
sense.
produce about 6 times less milk than a cow does. So the milk needs to be extraordinarily nutritionally rich for the baby camel.
It's super creamy. We had a camel milk testing in here a few months ago. And it's pretty creamy, pretty tangy,
pretty
but it's
fatty.
good.
It's beautiful, yeah.
Yeah.
And we discovered, really through a process of trial and error and feedback from people, people would say to me, my skin problems have lessened, my psoriasis has gone down, my eczema is improving. And we think it's a combination of two things. One is they've moved to a more natural product with a lot less additives. Mm-hmm. And two, the camel milk is genuinely a very soothing. It's full of vitamins, full of minerals. And that we use 30% fresh milk in our handmade products. That's a lot of milk.
That's a huge amount of milk.
It's a huge amount of milk, yeah.
So what's the remaining 70% in there?
So in our Castile soaps, and I'll show you kind of what they look like. So in our Castile soaps, which are the products in these like little sandy-coloured bags,
right.
These would be all olive oil. So this is the soap that really I created to try, not so much to compete, but an homage to the soaps of the Levant, of Syria, Lebanon, and Jordan. So they put 30-40% rar, and the rest is olive oil in theirs. Right. And so this is an olive oil soap. This range of soap, which we call our heritage range, is 30% camel milk, fresh camel milk. And then to that, we have oils, and we use olive oil, coconut, and shea butter. Mm. So it's a different feel on the skin, different bubble size, different texture, and it's a very personal. It's a very personal thing for what people prefer. Yeah,
yeah, that makes sense. I mean, I'm looking at that. I'm wondering what it would be like on your skin, because soap's supposed to take off. I don't know. Soap's supposed to take off the grease. Does it leave like a?
It leaves your skin feeling really moisturized, and I think that's what always surprises people when they've used a handmade soap like this, is that when you've used a detergent bar on your skin, you feel stripped, clean, but the skin often feels a bit dry, tight, and taut.
Yeah.
When you use a natural soap, you can feel the oils. You can feel the moisture, and that's partly because of glycerin. So the glycerin attracts moisture, mm-hmm. So it keeps the moisture on the skin, but also because of the oils that we're using.
I didn't think I'd learned so much about soap this morning.
Yeah, it's kind of interesting, isn't it?
It is kind of interesting. I wanted to get back to your appeal, because we didn't break down the maths in that. Your aim with the Save Our Soap campaign is to sell 25,000 bars of soap, right? You've sold millions in the past. I get that, but you want to do that, then that will help you get through the summer. What is it? Why the 25,000 bars? Why is that the magic threshold?
Yeah, it's really quite simply, we just simply calculated the cash input that would keep us going through the summer.
Okay, simple as that.
It was a simple maths, yes. I mean, I think Lucy in the beginning wanted us to do something like 300,000, and I said, I think that would be unrealistic. And to be quite honest, if I wanted to choose a number that we could target and people could see the ticker going and know we've achieved something.
Okay. But if you did get to 300,000, that would
Oh, I'd be super happy.
blow the soap out the water kind of thing, wouldn't it? I mean, that would, you can use that line. I apologise, top of head. Do you know what's interesting listening to you? And it is fascinating, and I mean that. There's a real feel of like a cultural value here, I think, as well. And yours is kind of homegrown IP, intellectual property as well. This is kind of unusual. It's a new thing. You've got a brand built on locally sourced camel milk, right? You've got premium natural ingredients, and then you've got this kind of Emirati heritage potentially for a global audience. So it feels like there's a real need to save something here. Does that make sense?
Yes, and thank you for saying it just that way. Actually.
No, I'm trying to.
I think that's what I'm trying.
Didn't put it brilliantly, but I'm trying to get there.
Yeah, for me, I guess it's more than ego and something that I've started. I didn't start this to make Stevie look good. I started this because I really wanted to give back to a country that I've lived in for a long time, and that I felt something was missing. I just felt that it was important to create something that reflected the heritage of this region. And I chose soaps because soaps have been traditionally used, especially in the northern regions, for years. And also because I could get my hand on ingredients, really beautiful ingredients that have been used traditionally. So, for example, our hair shampoos, we do solid hair shampoos and conditioners, use cedar, which is a traditional ingredient that's been used across India and the Middle East for centuries. It's a leaf that they crush, and it's a natural shampoo. So yes, there's an element of creating something that people can be proud of, and I think to lose that brand and to lose what it stands for, and there's a lot more like me, by the way, would be so sad.
It would, and it's not just about if you lose a local manufacturer, you lose jobs, fine, but you also lose a little bit of cultural identity there, and I think that's kind of important to highlight. Also, if you could maybe invent a camel milk shampoo that helps your hair grow back, customer sat right in front of you.
Oh, okay. I'll get David developing that.
That's your next mission, should you choose to accept it. What's the response been like since you went public with the campaign? Are you seeing like buy local sentiment kind of translate into real transactions?
Yes. I think, well, it's early days still. Right. I would say we've had Eid and
You're like 5 days in, aren't you?
Yes. Yeah. What has really touched me is how many people have responded personally to say, I love this brand. I do not want to see it go away. I buy this brand all the time to take home to granny, to family, to friends. So that's been very, very touching. Most people have also responded, I've gone out and I'm going to go out and buy, or I've gone out and bought. So what we really need to do, of course, is widen our reach. And that's why we're asking people to repost it as well. But I'm also hoping that part of this is not just about soaps, is getting people to start thinking of the impact of how they spend their money locally can really impact a lot of local businesses. I am not the only one who is struggling through this. I have spoken to so many of my other friends who've started companies, and this is a problem across the board. And it's just getting people, I guess, to think about how they spend money. We're not even asking people to buy 10 bars or 20 bars. We're just saying if each resident bought 1 bar, we'll be all right.
No, it makes sense. Look, I'm really short of time. Do you mind if I call you a veteran of the Dubai startup ecosystem, not a veteran in any other way? I wanted to ask you for some advice for SMEs, really. Is there a red flag that people any kind of homegrown product founders should be looking out for in their own supply chains, based on your experience?
I mean, right now, the problem for most of us is cash flow.
Right.
Liquidity.
Yeah.
I mean, that's the simple problem. I think anybody buying in is you've got to look at alternative suppliers. So we are really actively looking. We have suppliers overseas. We're looking to see, can we source more locally? Right. Although local suppliers, of course, have problems themselves because they're often reliant on raw materials coming in from outside. So, to be quite honest, no matter if you buy in from overseas or you buy in locally, we're probably all hit by the same problems. But I do think one of the lessons for us is you have to have a supply chain that's quite robust. Luckily, ours is not bad. COVID taught us that. COVID was massive teacher for us in terms of getting our supply chain more varied, wider, expanding our customer base, expanding the amount of products that we made. This could have happened 4 years later. I would have been happier.
I can well imagine. But I mean, that's a story we've had a lot. The support that really weird words to use, support from the COVID experience. But it seems to be what's happened.
Yeah.
It's something that has taught a lot of lessons. Final question for you, Stevie. Message for listeners who want to support local businesses. What would you say to people?
Can you just buy one soap? Go into our website, go into Carrefour, go into Spinneys, go into Al Jabba shops that are empty at the moment in every single mall around the UAE, and just buy one soap. We would really appreciate that.
Right. Look out for the Save Our Soap campaign. Stevie Lomas is the founder and CEO of the Camel Soap Factory. It's been genuinely interesting talking to you. Thanks for coming in.
Thank you.
Really appreciate it. More business interviews, conversations coming very soon here on MIRA Business FM. Remember, we stream 24/7 on YouTube, TuneIn and Streamer.
MIRA Business FM. The sound of success. MIRA Business FM, where business comes to talk.
It's the Morning Drive, the June the 1st, 2026 legal reset. For weeks on the Morning Drive, we've been tracking some pretty big legislative overhauls that have hit the UAE, the Emirate of Dubai as well. Look at the new shared housing regulations, sweeping updates in public safety laws. They're all available on the Fine Print podcast in some detail. Now that we've passed the June deadline, the June the 1st deadline, these reforms are officially active. So beyond the headlines, what do they look like in the real world? And what other critical changes do businesses, residents and investors face, including brand new private sector salary protections and the landmark legal shift, lowering the UAE age of adulthood from 21 to 18. It's a lot to talk about, a lot to unpack. And as ever, Raymond Kiswani joins me for the Fine Print. He's a partner at Davidson & Co. It's nice to see you.
Good morning.
Welcome back.
Thank you.
To the studio. So June the 1st, Raymond, feels like a little bit of a regulatory reset in some ways. What's the front line, if you like, this morning of impact this morning after yesterday, all of these?
Yeah, so I mean, this has been kind of, let's call it sort of 6 months leading up to yesterday, where there's all these kind of major legal changes that are now officially in effect. So up until now, we've sort of been highlighting how businesses and people should start kind of getting themselves ready for this. So now, if you haven't gotten ready, you're in sort of a little bit of a danger zone, and need to really step it up. And if you have, then now it's the time to really look at where you need to be, because this is now officially the law on the books.
Yeah, I wanted to get into the details, and I suppose we should start with arguably the kind of philosophically and commercially profound change taking effect, and that's the age of adulthood. To me, at least, dropping from 21 to 18 isn't just like a symbolic milestone. It kind of fundamentally alters the mechanics of civil law. I think it's hugely significant, and we've talked about this in some detail. But if an 18-year-old can now enter into a binding contract without a guardian's co-signature, what are the immediate ramifications in terms of, I don't know, corporate liability, or in terms of real estate transactions, or banking systems? There's a lot to unpack.
Yeah, there's quite a lot, and it's. I think that you are right. I mean, this is quite a significant legal shift. Yeah, and it's quite a legal shift in several ways, because not only did it bring the age to 18, but it shifted it from, because previously it used to be 21 lunar years following the moon calendar, and now it is 18 Gregorian years. That's right, so following the Gregorian calendar. So it's both a shift in the actual age, but also kind of tying up so that, because previously you used to have some laws following lunar years, some laws following Gregorian years. So now it's all kind of tied in together. But really, it means that an 18-year-old is now generally treated as an adult for all civil and financial matters. In practical terms, this means that an 18-year-old can enter into binding contracts, managing assets. They can file lawsuits and have lawsuits filed against them. So effectively, all the kind of legal obligations that are available to an adult is now available from a person being 18 onwards. So this means things like employment contracts. Employers can hire an 18-year-old directly. An 18-year-old can be able to open up a bank account. An 18-year-old can be able to have their own phone plan. They can be able to rent property, etc. So that's all the things that they can do. So effectively, an 18-year-old is no different than a 28-year-old or a 38-year-old. Yeah. I say this generally because we do have to understand that that just because they can sign doesn't necessarily mean that they're going to be able to do certain things. So, for example, I would be hard pressed to be seeing that a financial institution like a bank would be giving out a personal loan to an 18-year-old if they don't have, if they can't show source of income, source of credit, etc. So, or for example, it doesn't necessarily force a landlord to take on an 18-year-old as a tenant if that tenant, if that 18-year-old can't show that they have enough funds to be able to pay for that apartment, for example, without a guarantor. So, but it is a major shift in the sense that an 18-year-old is now effectively a fully fledged adult for all kind of civil matters.
I mean, it lifts the parental kind of safety net, doesn't it? That's kind of the point, I suppose.
It's a bit of a double-edged sword, right? Because it is providing them with greater autonomy, greater ability, but with that comes responsibility. It's always kind of a balancing act, shall we say?
It's very Spider-Man.
Yeah, exactly.
Is it Spider-Man or Superman? It's Spider-Man, isn't it? I'm looking at Faraz because he knows.
I mean, you're asking the wrong person. Yeah,
Spider-Man. Yeah, he's nodding. That's good. I'm like, phew. That would come back to bite me, that's for sure. So 18-year-olds can legally do lots of things now that, in theory, legally they couldn't do before. How do you see this affecting employers or landlords or banks or service providers in terms of, do you anticipate any changes?
It's a good question. I mean, so again, generally speaking, an 18-year-old now can act independently in virtually all of civil and financial matters without needing a parent or a guardian to kind of hold their hand, shall we say, to sort of sign stuff. And that's going to include things like signing all types of contracts, managing finances, entering into agreements, renting property, buying and selling assets, dealing with banks themselves, etc. So they will be treated no differently than any other adult from the age of 18. And again, I use the word generally because some activities will still be subject to specific laws and regulatory approvals, for example, or just internal policies. I mean, as an example, an 18-year-old will have the legal capacity to sign a contract, but that doesn't automatically mean that a bank must approve a loan or a landlord must accept them as a tenant, because they might have their own regulations. I mean, it would be difficult to sort of see how a bank is going to give a personal loan to an 18-year-old if that 18-year-old doesn't have any source of income, doesn't have any collateral, doesn't have any ability to repay that loan. Similarly to a landlord, how would you be able to show that you'd be able to pay this rent if you don't have a job or anything like that? So, sure. It gives a legal capacity, but it may not change certain things. So you might still find a bank will say, we need a guarantor for this loan in order to process it. You might have a landlord say, yes, you can sign the tenancy contract, but I need a guarantor that you're going to be paying, for example.
Well, let's take that instance as an example. If you have a guarantor of that loan, there is still legally the 18-year-old is still liable in this case, as well as the guarantor.
Exactly.
So there are two people to go after now, kind of thing.
Yeah, exactly. Yeah. So previously, where the 18-year-old is kind of nowhere to be found within the contractual matrix, if you will. Yeah. Here you would effectively be able to go after the 18-year-old, but financially you'd want to go after the guarantor because that's where you have those funds. So you'd the 18-year-old, 19-year-old, whatever it may be, might have, just again, because you can bring a case against an 18-year-old now that you wouldn't be able to do that previously. Sure. So again, it's that kind of double-edged sword of more autonomy, but you still need to have that responsibility.
We're back to the responsibility.
Exactly.
Let's go from individual rights to the kind of operational realities of living and working in Dubai today. The new shared housing rules are officially active. They the aim is to regulate high-density living subleasing, obviously. Concurrently, the new private sector salary rules are live as well, and that's to tighten compliance through the WPS, the Wages Protection System. So mechanically, how do these two laws change? Do they change the daily lives of residents and, I suppose, compliant checklists for HR departments?
Yeah, so they're two sort of separate matters. The shared housing rules, these require sort of paying attention to things like permit, occupancy limits, safety standards, etc. Because the shared housing rules are aimed at regulating how properties can be used when multiple occupants are living in the same unit or in the same place. So that affects landlords, property managers, the real estate brokers, etc. So I mean, the main points there is don't just assume that any unit can be converted into a shared accommodation. It has to fit within certain permit requirements. Yeah. That's in terms of the shared occupancy thing. In terms of the new salary, is that a very important shift is that, you know, no longer is it if salaries are late, that is that a private dispute between an employer and an employee. It is now a regulatory matter that the employer can have against them if they are not making sure that those payments are going out on the first of each month.
Right. Okay. We talked quite a lot about the new shared housing rules before. I wanted to come back to that briefly. What should businesses, what should property owners be paying attention to now in particular?
Yeah, it's so I would like to think that they should be paying attention to things like permits, occupancy limits, safety standards, and who's legally responsible for complying with all these. Right. These rules are aimed at regulating how properties can be used by multiple individuals that are unrelated living together, right? So the main points are making sure that you're checking what the permit allows for, you're complying with occupancy and space requirements, and you're actually making sure that the contractual structure reflects what is being done in the property. So if you're a property owner, the issues to look out for is regarding subletting, for example. So landlord may think that a unit is leased to one tenant, but there may be in practice where it is being used by shared accommodation. Yeah. This creates a legal and regulatory authority exposure where if this arrangement is not properly authorized. For employers and staff accommodations, that should also be reviewed in the sense that the housing is provided as an employment benefit. That doesn't remove the need to comply with the housing requirements. So the practical advice here is audit the property, make sure that the tenancy documents are accurate and correct. Check the actual occupancy as to actually who's living in the unit, and confirm whether there's any additional approvals or permits that are required. Okay.
Highlights from this conversation are going to be on Instagram, by the way. Just a reminder, if you haven't subscribed, why not do that? Do you know, we haven't had the chance, Raymond, yet to cover the new private sector salary rules in any detail. But I just wondered if you could look at, what's changed there and what do employers first of all need to know?
Yeah. So the main change is that private sector salaries now must be paid. They must be paid on the first day of each calendar month for the previous month's work, and has to be done through the wage protection system, the WPS. Yeah. This is a very significant operational change for employers who historically paid salaries later in the month or use kind of a flexible payroll date. Employers need to understand that late payment is now not simply just a private dispute Like we were saying, it's now a regulatory issue because of this law, right? So if you're a business, I would check a few things. I think firstly is your payroll timing, making sure that, can the company actually process salaries by the first of each month? Making sure your cash flow is there. Does the company have the actual funds available to be able to meet that deadline? And thirdly, making sure that you're making those payments through WPS, making sure that all your employees are correctly registered, their salary details are accurate, and the payments are being made through the WPS. The other thing is that employers should review their current employment contracts along with HR policies, because if a contract says salaries payable by the 5th or the 10th or the 15th day of the month or anything other than what is under this law, that wording needs to be reviewed and changed because it's no longer compliant with this law.
Okay, and how does that work within the framework of the new law? Does the new law just supersede that? If you did have a dispute, and for example, you'll be paid on the 5th, but the law now dictates you should be paid on the 1st.
Yeah.
What would happen?
Yeah, exactly. So I mean, it would effectively be that clause in that contract, if it's saying the 5th or the 15th or whatever it is, would be ignored, and just because there is a very specific law on the books that's saying it has to be done by the 1st. Okay. So if it's being paid on the 2nd or on the 3rd or on the 5th or whatever it is, it's going to be considered late and going to be considered illegal. Okay.
So businesses need to update contracts and policies, compliance procedures, whatever it is, in lieu of what's happened.
Exactly.
How do the new salary rules penalise corporate entities that maybe don't process wages on time?
Yeah. So if they are doing it, again, it's not just I might have an employee raise a dispute against me. It becomes a regulatory issue because under the WPS, if you're not making it through the WPS or you're not doing it by the 1st, that becomes a regulatory issue that you can get fined on, that you can have all sorts of issues, even when there's not an employee dispute, because it is effectively a regulatory issue now. Gotcha. It's not just a private dispute between.
But potentially there may be fines at some point or whatever.
Absolutely, yeah.
So it's kind of zero tolerance, isn't it?
Exactly, yeah.
Okay. Yeah. There's also, I was thinking about this, there's kind of a cultural shift here as well, that we're moving the kind of UAE corporate market away from kind of legacy arrangements, informal labor arrangements. Yeah. It's a highly traceable, it's institutionalized.
It's very transparent.
It's very. There's a real framework.
Absolutely, yeah.
Okay. Lots to talk about today. We often look at how new legislation impacts businesses' scalability on the fine print. The new public safety law, I want to turn our attention to that. It places a much higher burden of accountability on commercial venues, on malls, on event organisers. We've talked about this in some detail, but now that we're at June the 2nd, from a corporate defence and risk mitigation perspective, what immediate operational audits should maybe business owners be running or thinking of running to make sure they aren't exposed or there are any potential liability issues?
Yeah, I mean, as we discussed kind of in that kind of specialized episode about this new regulation, it is kind of updating all things related to kind of generally health and safety, rather than it being in various laws. You had one that dealt with fire, one that dealt with occupancy, one that dealt with. We're kind of bringing all these things under one kind of umbrella uniform regulation to deal with all things related to fire, safety, occupancy levels, all these things. So especially for event organizers and buildings, malls like this one, making sure that they are complying with all these regulations. And one of the things that's often overlooked is, there's a little bit kind of who's responsible and making sure that it's understood as to who's responsible, because you have the owner, for example, of the mall or of a concert venue, and then you have the promoters of the concert venue, you have the security of the concert venue. Who is responsible for making sure that the occupancy limits are set in place? Who is responsible for making sure that the fire exits are accessible, et cetera? So that, I think, is just as important, because then we're not going to be able to have that kind of finger pointing of, well, I thought he was doing it. No, I thought he was doing it.
So that just can't happen now. What kind of misconceptions are you hearing about these new laws? Anything yet?
I mean, I think that there's quite a bit. I think we often kind of struggle when laws first come in as the kind of the confusion around how do they apply, where. What people should be doing. I think the biggest misconception is, there's going to be a bit of a grace period. We're going to sort of play it here and there. There's been quite a lot of advertising of these new laws through various means, from the government, from newspapers, from whatever, that I think everyone is on notice. So I wouldn't be surprised if the enforcement doesn't start earlier than we usually see, because we've been talking about this for at least 6 months, and they have now come into effect. So I think that there's quite a lot of industries that are affected. Some of them may not realize that they're as affected as they actually are, and those are other misconceptions there.
Well, it's the things like emergency access, isn't it, in buildings? It's the emphasis, I think, on physical safety here as well, that perhaps some business owners don't think about as much as maybe they should.
Yeah, I mean, especially on like the shared housing rule, I think that there's a real misconception there that this is only going to affect kind of low cost labor related accommodation. They can also affect, co-living arrangements, staff housing, partitioned apartments, kind of informal subletting, even corporate accommodation. So it's not just a kind of I think the shared housing one is probably one of the most ones where most people sort of just read the headline and kind of moved on, because it seems like it's one that doesn't affect a lot of people as much. Similarly about the public safety law, that it only matters after an accident about investigations. It's the reality with that is that it's much more about preventative compliance. So I mean, there's those kind of misconceptions, I think, are still kind of running high.
I mean, there are risks for businesses that fail to adapt, and as you say, I mean, there's been a lot of coverage. This has been in the news regularly. That's certainly true. But what's the big legal risk for businesses that don't adapt?
Yeah, I mean, I think this is actually another misconception. The biggest risk is not one single fine; it's the cumulative exposure, right? A business that fails to adapt may face regulatory penalties, employee complaints, contractual disputes, insurance issues, all of those kind of things. But if salaries are late, that may trigger employee complaints and regulatory consequences. If a premises incident occurs and safety procedures are weak, that's probably going to create a civil liability enforcement risk. Your insurance might be at risk there. So if a business is signing a contract with an 18 or a 20-year-old using outdated wording, there's going to be enforceability issues. So the broader risk, I think, is that businesses look non-compliant and poorly governed, and that's going to be quite a bit of a reputational issue that doesn't just involve their regulator, their banks, their insurance. It's just going to involve the entire market.
Okay. If you're a business owner listening to this, watching this morning, is there one thing that you should make sure you deal with?
Well, if you haven't already, I would certainly do an audit right away in terms of all of these things. Looking at your employment contracts, making sure if you have any employees that are in that age range, or you're planning on hiring employees that are between the 18 age range, making sure that those contracts are correctly reflected. Making sure that you have the systems in place to make sure that those salaries are correctly and adequately being processed by the first of the month. If you are at all operating within a premise, making sure that the premise is following all those kind of public safety laws. If you have any of your staff living in accommodation, that you make sure that those are compliant. So I mean, if the answer to any of those is that you haven't done those yet, I would certainly make sure you identify them immediately. And
if there's a not sure,
yeah, exactly. Because the practicality of the matter is don't wait for a complaint or an accident or inspection to be finding it. Process it now, document it now, so that if there is ever an issue, if there ever is a knock on the door, you are fully prepared.
Sure. Okay, so these are things, these are changes, laws that have come into effect on June the 1st. We've been talking about them for a while. The legal system, the introduction of new laws happens apace here. We know that. Keeping up with it is hard. If I was to say to you, looking ahead, Raymond Kiswani, what should residences and businesses be watching for next? Is there something on the radar that we should be considering?
Well, I mean, this is kind of one of the beauty of this place, is that it is always evolving, and it's always evolving in a manner that is making things simpler and easier, right? So I would watch for implementing these regulations, kind of any guidance notes specifically about these laws that will come out soon, because those guidance notes will be a huge aid to all of these specific laws. And look out for sort of how enforcement trends are going. With reforms like these, the law is only really the first stage, and the second stage is how authorities begin to apply it in a day-to-day practice, right? So for businesses, it means monitoring guidance from the Ministry of Human Resources on salary compliance, Dubai Municipality or other authorities on public safety and shared housing, and how those guidance are being done. Residents, I think it would be wise to pay attention to how these changes affect their everyday contracts, their tenancy agreements, their service contracts, their employment contracts, their bank documents, their property arrangements. Watching out for those and following kind of the official guidelines to seeing how these are actually being implemented day to day.
That is the fine print for another week. Raymond Kiswani is a partner at Davidson & Co. And as always, thank you. Appreciate you.
Lovely. Thank you.
Most of our interviews, including this one, are podcasts. They're standalone features in one way or another. Just search for MIRA Business FM and select wherever you find your podcasts.
MIRA Business FM, Dubai's home of business radio.